Hello, everyone. Welcome to FAPI Educational Webinar Series. It's the first of its kind in that we are discussing non-medical this time. And today's topic will be about the hot topic of the day is tariffs everywhere. So it's going to be tariffs and how to invest in this market and also about estate planning. So FAPI's goal is to educate the members about the importance of financial planning, but attendees should consult their own advisors and attorneys for any advice. And welcome to the session. I'm Dr. Mahathi Reddy. I'm the president of FAPI. And today we have two great speakers with us from Wall Street Alliance. I have Syed, Nishat, and Keviin Shah. Thank you both for joining us. Keviin is a fiduciary advisor and financial planner at the Wall Street Alliance Group, and Syed is a certified financial planner and a certified plan fiduciary advisor. I'm sure many of you have met them also through our previous FAPI events. Very supportive of FAPI, and for that, I thank you. So this is a very short webinar that addresses the current market volatility due to the tariff situation and how the investors should allocate their investments. Please be advised that we will not be discussing buying any individual stock recommendation. This is purely an educational webinar. The format of the webinar is also going to be a Q&A session. We don't want it to be any boring presentation, but very much interactive. So feel free to ask your questions in the chat box. I'll be asking the questions and Keviin and Syed will be answering, but your question should go into the chat box. So we'll get started. All right, Syed and Keviin, don't know who wants to take the first question, but can you please explain what tariff is? And so why the issue with the tariffs now and what is the significance of this?
All right. Thank you, first of all, Dr. Reddy, to inviting us and working on Sunday. It is really volunteer what you do. I don't know how you do it, but I really appreciate it for the FAPI members who are doing it. Really appreciate it. So as we mentioned, this is going to be an educational webinar, and it will be recorded, and we'll send the recording to all the attendees as well. So first of all, the most important question people are asking, what is tariff? What is the significance for it? But just to get you started, tariff has been there for a long time. Well, hundreds of years, tariff has been there. What does tariff means? It's indirectly, it's like paying taxes, pass on to the consumer. Whenever US actually bring products from overseas, there's no labor costs in America. So other countries basically have labor and then they sell the products to United States. But US will actually charge some money so they can make the revenue, the government collects it. But what happened that the companies like Apple, Amazon, Google, they make their product, let's say, for example, in India, they bring it here, they want to charge some money, which is 5%, 10%. So the government basically collects the revenue. That's what the whole idea behind it. But technically, what happened, the companies have a fiduciary role to make money. So they pass it to the consumer like you or me. So tariff is like a tax that actually pass on to the consumer. Now, your question could be that, okay, if it's there for a long period of time, what is the significant right now? The two reason why tariff came in, I'm just talking about economy point of view. Whenever I talk about economic, what happened, Dr. Reddy, people become emotional, like you were mentioning the emotion run highs when we talk about politics. So the whole idea was that if you see treasuries, when you invest treasuries like the government bonds, their rates are going higher, although inflation is low. Why treasury is going higher? Because what happened, China, other countries own a lot of our government bonds. They're selling it for the last couple of years. And that's why the bonds, yields are going higher. 30-year yields are going higher. What the government is doing, hey, you are selling all our treasuries, the yields are going higher. There, and the trade deficit keep going high. What I mean by trade deficit, and let me just share my screen here to get started. So US basically, imagine Dr. Reddy, the house you are staying in right now, there's expenses. You earn money as a physician, you spend the money. So US spends around close to $6 to $7 trillion every year. You as a physician earn money, US earn money as well. Where do we earn money? From you, taxing Kevin, taxing me, they're earning it. And the revenue they collect around close to 4 trillion every year. So 6 trillion they spend, 4 trillion they basically make. So the net is 2 trillion, it is the budget deficit. So the Trump administration came up with a logic that to reduce the budget deficit every year, because if you look at the chart, so far for the last 1 year, the deficit is almost 2 trillion. What's the best way to do it? Number one way to do it is basically Dodge. I'm sure you've heard of Elon Musk. You heard about Dodge, right? So that social security fraud, 1 trillion comes from there. Number two is this trade deficit. Like, for example, China product comes in America here, we only buy 2.5%, but American product goes to Europe, we pay almost 10%. So to fix the trade deficit, about close to 500 billion will be coming from there. So 1 trillion coming from there, 500 billion comes from there. And you must have heard about Trump Golden Visa. That's if you invest about 5 million in America. So basically what happened, you become automatically a US citizen. So that's another 1 trillion. So altogether, this 2 trillion, this budget deficit, we have it. This is something that Trump administration come up with, and the tariff is part of it. But the problem, Dr. Reddy, is the way has been overall described. Because if you see it, that there are tariffs everywhere and it's keep changing. And there was a joking, I think, came in CNBC that there's a Hart and McDonald Einel, there's a lot of penguin there, and Trump is, giving 10% tariffs to penguin as well. So, the way it has been described, the way he's doing it, and that's why, is jittering the market, and that's why the market fell. But if you're asking me that what's the main purpose for it, the main purpose is to balance the trade deficit. In our opinion, most likely, um, a tariff deal will happen because I don't think other companies will be able to compete with America. Because if you take a look at the chart, US consume almost $3 trillion import. They're bigger than any other country. So I don't think other country will be able to negotiate power we have it. So we believe personally it is a short-term turbulence going on. The deal will happen in the next 3 months and the market will go up. That's what our overall intake is. I know it's a long answer of a short question you asked, but hopefully if it makes sense.
Yeah, absolutely. Thank you for that. So is the tariff for bringing the job back or just negotiation, in your opinion?
Yeah, so I think the way the administration has been, if you see the whole speech, they're talking about bringing the job back, bringing the job back. Like, I don't think that is possible because the US unemployment rate is below 5. All right, so what job are they going to bring back? If you see the manufacturing doc just talking about, the demand is keep going down. The whole idea of tariff is, Dr. Reddy, like I'm from Dhaka, from Bangladesh. So what happened that we have this garments factory. Like this suit is very expensive, but when I wear it, it looks cheap. But if you look at the back of the label, says made in Bangladesh. So what happened that we bring this product here, but we employ a lot of women in Bangladesh. So garments factory it is called. So for one country, what happened in the US, they don't want to make this clothes here and they ship it to Bangladesh and Bangladesh basically ship it here. Their standard goes up, but meanwhile, we are bringing the clothes cheaper here. I don't imagine that some cowboy from Texas actually making these clothes here. I don't see it's happening. So the manufacturing job is going down regardless of what happened to demand. So if you take a look at the demand, which are the sectors? I mean, there's a huge shortage of healthcare. If you take a look, huge shortage. That's why 1 out of 6 physicians in US are foreign born. There's a lot of demand for technology in America, a lot of demand for professional service here. So the way the administration is talking about being in the manufacturing drug, it does not make sense. It is more of a negotiation deal, in my opinion, because 82% of other countries have a favorable rate, tax rate. US doesn't have a favorable rate. I think mostly it is a negotiation tactics. Manufacturing job, unemployment is very low. So I think the latter is more of a what the government is trying to do. So in my opinion, it is not a job. It is more of fixing the budget deficit, and that's what the government is trying to do.
Wow, look at that. Nurse practitioners are 44.5% fastest growing.
Absolutely. Right.
Physicians are nowhere there on the list.
Right.
So, what are the chances of recession, though? What is the worst case scenario and the good case scenario in this situation?
Yeah, a lot of people ask, what's the worst case, what's the good case scenario? So, worst case scenario, Dr. Reddy, it will be a long recession. I mean, I don't know when's the last time you've been to India. India onion price can go off like 100%, 50% through the roof very quickly. So what happened after the physical war, economic war is the worst. So, in our opinion, the worst case scenario, if there's no deal, we're talking about things goes through the roof prices, clothes, sugar, salt, everything will go through the roof, and we're talking about a nasty recession due to inflation. High inflation will happen, and we're talking about 3 years bad recession. That's the worst come to worst scenario, which I don't think that is the case. That is like, you're shooting your own foot. Does not make any sense to me. Best scenario, in my opinion, which we believe is going to be a short-term recession, and Fed will cut the rate. And you heard, last week, Trump administration talking about firing Powell. Cut the rate, cut the rate. I know that he has unconventional way of doing stuff. I think the best case scenario, Fed will cut the rate, negotiation will happen very quickly. But if you remember that already, during COVID time, market was collapsing. Patients were dying left and right in New York City. But the market, as soon as a news came in that there's a vaccine coming, market shot up. Similarly, I think market is forward looking. As soon as a news come in that trade deal is happening with China, the market will shoot right back up. And that's, I think, is the best case scenario. Most likely that's going to happen.
Got it. And so, since I'm hearing that the market will crash, why not sell everything and let things stabilize?
Yeah, what you don't want to do, Dr. Reddy, is time the market. Like just about 2 weeks ago, when I was doing this API webinar, I got an email, all caps. If the market goes below 5,000, sell everything. This administration will make havoc to our country. Makes no head, no tail. So what I highly recommend, try not to time the market, is because there's no way we know it how to beat the market, time the market. Like think logically already. If I know you know how to time the market, we would not be doing this webinar on Sunday. I'll be a billionaire right now. Keviin will be a billionaire right now, right? It is not possible to time it. And if you take a look at the statistic, like for the last 20 years, since 2001 to until 2020, the S&P return was around close to 8% per year. Let's say you missed the 20 best trading days, like 20 best time the market going up, you missed it. Your return instead of 8% becomes 0.09%. I'm just hovering my mouse. And you, for some reason, missed, let's say you say, look at, Syed, the market is going down. Let me just stare the market 40 days. I'm just giving example. Your return will become negative 3% per year for the last, I'm just talking about 20 years if you miss the best trading days. And usually the best trading days happen when the market goes down. Like, for example, if you take a look post-COVID, the market went up almost 100%. If you take a look at early 80 recession, the next subsequent 5 years, market went up 88%. Who knows when the best trading day is going to be? So that's why we should not time the market. We should not sell everything. My suggestion will be before the market crash, you must have an objective, stay with the objective. Like I'm 45, I'm not retiring until age 66. Market goes down, doesn't matter. I'm going to hold on to it. If I have cash, it is a good time to dollar cost average. And we will talk about in the subsequent slide, dollar cost average is the market down. That is a better approach. Stick with the market. Don't try to time the market.
Got it. Thank you. So if since the S&P is down about 6% or so, but some of us are down 20%, why is that?
Yeah, so this is one thing I think I want to show it to you. This is a chart on April 8th, which is about a couple of weeks ago. S&P was down about 15%, but now S&P is down about 4 to 6%. But what happened, a lot of API and FAPI, I would say Indian clients, I would say it, for some reason, their portfolio is down a lot. The reason is because what happened, all they do is buy Magnificent Seven stock. They buy Apple, Nvidia, Microsoft, Amazon, Google, Meta, Tesla. I don't know why. All they do is just buy this seven stock. I mean, we keep telling them in all of it, why do this? Because, this is fun. This is like, you have WhatsApp group, they chat about it. I do this. This is what Indian physicians do, and a lot of physicians do. And this is why what happened that their portfolio went down a lot. So they buy SPY plus they buy this seven stock a lot. And if you think logically, last year, this is 2024, S&P went up almost 25%. 60% gain happened from these stock because S&P is not diversified that much anymore. These have this 60% of the gain came from this seven stock. So what physicians are doing, especially FAPI and API, they buy SPY plus they buy these seven stock across the board in the portfolio, and that's why their portfolio is down a lot. So our recommendation would be don't buy just Magnificent Seven. Try to buy some international. This is one recommendation we have it for all FAPI members, API members that try to buy international. Everyone should read this book, Ray Dalio's book called Principle. It's a very good book to read because every country is becoming self-sufficient. I think international buy some gold in this portfolio and buy some bond into this portfolio because that sector will go up. Putting everything into Magnificent Seven and SPY, I think is a mistake, and that's why their portfolio is down a lot. Hopefully the answer makes sense.
Yeah. So the next question would be on that. I have a lot of concentrated positions in NVIDIA. So should I sell it? What should I do in the market?
Yeah, unfortunately, this is a tricky question. What happened that like 2 weeks ago, we had a client, and the client said, you know what, I had NVIDIA, I want to keep it. And if I die, what happened already that if you have concentrated position or any asset you have, but if you pass away, your children inherit it. If the money, and that Keviin will talk about, in a revocable trust, you receive a step up in cost basis. So what I mean by that, you bought it like $100, Nvidia stock is 200, you pass away, the money get passed along through a revocable trust. 200 is a new cost for the heirs. So that basically is a step up in cost basis. So we thought about for the client, hey, you have a lot of Nvidia shares. If you die, client was old, if you die, you get it. But guess what? What happened? Market collapsed. The client is nervous. I still should have sold it. So it's very, very common. One option could be then if it's not too much of net worth of your portfolio, keep it. Hopefully the stock will go up, but there's no way to guarantee it. Second option could be sell it now because what happened, the Nvidia is down, taxes will be less. Use this money and buy other similar sector like PLTR, Broadcom, QQQ. Now it's a good time to diversify it and the stock may go back up. So you cannot have both sides of the equation. You have to make one decision. If you're nervous, you should diversify it anyway. It's a good time to maybe sell it and buy similar sector. But if you really, really love it, can afford to take a risk, you can keep it for a step up in cost basis. So I think this is something you have to discuss one-on-one with your advisor. But it's a tricky question. It's hard to answer without sitting down with the particular person.
Right. So what sector should we invest in?
Yeah, so the sectors we believe it will go higher nowadays is number one, financial. Try to get into the financial sector if you can, because Trump talked about deregulation. So I think if the financial sector will go higher, try to buy some utility if you can. Is because of the AI. Everyone is buying AI, but in India, I'm talking about Gujarat. There's a huge, I think, data center they're making, and the data center they need a lot of electricity. So I think the utility sector like Con Edison, XLU will go high. Try to buy those. Try to have some gold exposure into the portfolio, at least 5%. Try to have some gold. That give you a cushion just in case a recession happen or inflation spikes up, gold goes high. And try to get at least 10% of a portfolio we recommend international, at least 10%, because for the next 5 years, Dr. Reddy, you must have heard about DeepSeek, right? This Chinese
Right.
AI, because what happened that China, other countries, they will go high. US last 2 years are 50%. Let me repeat, 50% market is up. International is not up that much. I think international is undervalued. And people are very biased about investing into China and international. So try to get into some international 10 to 15% of your portfolio because that is undervalued, will go higher. So again, financial, utilities, gold, international, try to have this exposure into the portfolio as well.
Got it. Thank you. So, what are the mistakes to avoid in this market?
Kevin? Sure.
Yeah, absolutely. I think there are three major mistakes that you want to avoid in this kind of market. Number one is margin. So in the financial planning world, we call this the kiss of death. Margin, you're taking some kinds of loans, buying these concentrated positions. Avoid using margin, just keep it simple, buy into the account. Second major issue that we're seeing is, like Syed was saying, a lot of the clients, they're only buying the same handful of five, six stocks, Nvidia, Apple. They're generating concentrated positions. What is concentrated? Anything that's typically over about 10 to 15% of the portfolio is concentrated. You should trim it. That you want to avoid as well, because like we're seeing, these stocks have seen a pullback year to date. So you want to make sure the entire portfolio isn't suffering because of that. The biggest mistake, though, I think that we are seeing is, like Syed said, clients are calling in, they're nervous, they're saying, should we just sell everything, sit on the sidelines, wait? But that's trying to time the market. If you do that, studies show, research show that you will fail. Inevitably, stay into the market, pick your investment objectives, pick your time horizon, and stick to the plan, stay to the course. Don't try to time the market because studies have shown you will fail if you try to do that. So these are the three major mistakes we're seeing in the market right now.
Okay, thank you, Kevin. How about buying life insurance as an investment in this market?
Yeah, some of our clients have thought about it. Some things that they can do right now in the market. They can buy annuities, they can buy life insurance, but honestly, I'm not a huge fan because the fees are so high. Instead, I think the things to do in the market right now are these four. Number one is Roth conversion. If you're an older client, market is down right now. If the market falls even further, we think you can convert some of the pre-tax money you have to Roth. Benefit is all your subsequent growth, all your subsequent withdrawals, it's all tax free. So very powerful. I think Roth conversion is one thing to look at instead of these annuities, life insurance, expensive kinds of products. I think tax loss harvesting, a lot of these concentrated stocks, like I was saying, Nvidia, Apple, Tesla, they've fallen. So you might have a loss in some of these positions. You can do what's called tax loss harvesting. You sell the stock at a loss as long as you don't buy the stock back within 30 days. You use that loss to offset any and all capital gains, stocks, and real estate. I think ultimately this is a great time, though, to think about what's called dollar cost averaging. Dollar cost averaging means that no matter what the market is doing, you are buying some a little bit. So even when the market dips, you're buying a little bit more. Over the long term, if you keep buying when you see these opportunities, even if market is a little bit high, you keep buying, in the long term, you will be ahead of the game. You will be at a lower cost basis than whatever the market is trading at. So I think dollar cost averaging, very powerful in a market like right now where we're seeing volatility. It's important. Do it a little bit. You don't have to buy the whole portfolio in, but just average it down right now, little by little. Finally, I think for a lot of the physicians, net worth is high. Might be a good time you can think about gifting some of the assets. Why? Because market is lower, so you're using less of the exemption. So you may want to gift some of the assets. When is it a good time to gift? Ideally, if net worth is somewhere in the range of about 20 to 30 million, this is when we start thinking you need to start gifting some assets because of the federal exemption. So we'll speak about that a little bit in our estate planning section next. But these, I think, are the things to do. You want to avoid these annuities and life insurance products because they're very expensive in the sense that they have a lot of high fees inside. Keep it simple. Go for the stocks, go for bonds, go for mutual funds, and ideally, if you can, go for the index funds. Those have the lowest costs associated with it. So these are really what we're seeing as the things to do and what I would stay away as a financial planner.
And I'll just add, Dr. Reddy, that FAPI members, a lot of them buy premium financing and life insurance. Very common. Florida is a retiree state. There's a statistic done is the highest number of financial advisor in Florida. All they do is take Series 7, 66 life insurance license, calling them some financial advisor. So if it's possible, don't buy life insurance premium financing. It doesn't work in the long run. And usually what happens, market goes down, this life insurance people come in and sell life insurance, VOL, annuities. They make all this claim, it never goes down. You will make a lot of money. So it is very common in FAPI. I see it. So if it's possible, just buy cheap term life policy. Whatever the saving is, just buy index funds like SPY, QQQ. In the long run, you'll be ahead of the game.
Got it. So maybe we should take a moment and see if there are any audience questions. Um, if anyone has any questions, can you please put it in the chat box? Keviin, do you see any questions? I'm not able to see any.
Yeah, nothing yet. So I think maybe we can keep going, and then at the end of the
Okay.
presentation, people may have some questions.
Okay.
And
And like as I said before, we want this to be interactive, so please feel free to go ahead and put in your questions in the chat box. So we'll go on to the next section, which would be the estate planning.
Yes, absolutely. I think estate
Oh, one
planning,
second, Keviin. I think the chat box is disabled. So somebody just sent saying that the chat box is disabled.
sure, let me just look into that.
you can make everyone, so like not many people, if you want to make everyone attendees,
Right.
yeah. Right click on it and you can make everyone attendees, Keviin. Upgrade to
Sure.
like, yeah.
Upgrade to like a panelist.
Yeah, if you want to.
Yeah, I don't see how the chat box would work here.
I can put chat box fine. I mean, I can.
Yeah, if you can do that, Syed.
So
Yeah,
in the
chat box is
meantime,
working fine. Chat
Yeah.
box is working fine.
really,
Yeah.
because so I have a question.
Mhm.
Any downside of canceling the premium life insurance in the current market?
Yeah, so what happened that already the premium life insurance, if you bought it recently,
Mm-hmm.
so what happened that there's a surrender charge out there.
Mm-hmm.
Every life insurance has a surrender charge. So what happened is you have to just run something called in-force illustration and see, when does if you cancel it, how much money do you lose? Because what happened, premium life insurance, you bought it. Usually to make it work, 10 years is a good time horizon. Somehow, if a policy is for 10 years, usually you break even. But the whole idea of premium life insurance is it happened in year 2021 or 2000. So you have stock equity account, you borrow money against it. The interest rate, if you remember already, was 2%. Remember the good old days, 2%. So 2% is the interest, and you borrow the money against your portfolio, and then pay premium for the life insurance. Let's say for 10 million, 20 million. Now it's a VUL product or IUL product. They invest into the stock market for you. The goal is 2% is the interest, market will give you 7%. But interest is not guaranteed, it's not fixed, it's usually variable. But the market collapsed, to 2022 market went down. And this year market may go down. So what happened? 7% is not happening. And the premium and the interest, that's the call that is due. So my recommendation will be you should run an in-force illustration, see how long you have to keep paying the premium to keep this policy alive. As soon as you break even means how much you put in and how much you're getting out. If it's like break even, you can cancel it. But I think you should run an in-force illustration, speak to a CFP. Don't talk to an insurance agent, certified financial planner, fiduciary, who will sit down with you and discuss if it makes sense to cancel it.
I hope that answers the question. That was Dr. Vaidjula asking the question. So yeah, we'll get started on the estate planning. Of this, I need a lot of learning too. So is a will enough, or do you need a trust as well?
Yeah, I think this is a great question, Dr. Reddy. Most of our clients, if assets are low, if it's just, talking about maybe a home, maybe few retirement accounts, then something like a will might just be enough. It's just a public document. But unfortunately, for most of the physicians that we work with, that's not all the assets that you guys have. There's more. There's real estate. A lot of them have brokerage accounts, other kinds of insurance policies like we spoke about. So I think just basic will not be enough. The primary reason for that is if you just have a will, there's still something called probate because it's a public document only. So in your will, you have things like your healthcare proxy, power of attorney. It might work if you only have few assets, but if you have more than that, that's where I think something like a trust comes in. So I would say that for a lot of physicians that we see, trust is necessary to avoid this probate process. A lot of the assets you have, you move everything inside the trust. The house that you're in right now, Dr. Reddy, any of the accounts that you have, you move that all inside the trust. You avoid the probate process. So I would say for some people, if assets are low, basic will is fine. But for most of the physicians that, are in the FAPI community, you'll likely need more than that so that you can avoid this probate process.
Good. So what is the difference between the revocable and irrevocable trust?
Yeah, absolutely. So I think from a revocable trust standpoint, there's a few things. Number one is you avoid the probate. Number two is you can actually create some levels of creditor protection for your children. So one example is, we had a client, they were saying, let me just give everything to my children in their individual name. They wanted to name the kids inside the trust. That's a mistake though, because if that child goes through any kind of divorce, any kind of creditor issue, and those assets are already commingled with the spouse, then it'll all get depleted. So in the revocable trust, ideally you want to keep some provisions, just make sure that money is going to the actual trust rather than to any individual name. Now, I think one of these major benefits of the revocable trust that is not in the irrevocable is something called step up in cost basis. So step up in cost basis means, Dr. Reddy, you bought Apple stock, let's say at $100. Now, 5 years later, you pass away, and at that time, the stock is worth $200. If you were to sell it, you would have paid taxes on that 100 to 200 gain. Instead, if the children inherit it, like Syed was saying, they get it at the value of 200, so they don't have to pay the taxes on that gain. It's all done if you put it into the revocable trust. So revocable, great for avoiding probate, great for creating some creditor protection for your children, and you get the step up in cost basis. Irrevocable trust comes in when you need to get assets out of your estate, when you want to do some gifting during your lifetime. So ideally, when do you want to do gifting during your lifetime? It's when your net worth is in that range of, like we said, around 20, 30 million. You need to get some assets out of the estate. That's when you can use something like an irrevocable trust, because trust is always, remember, it's a private document. Will is the public document. So this will still avoid your probate, but the primary use for this irrevocable trust is to do gifting, get assets out of the estate.
Got it. But this one has no step up in the cost basis.
No step up because you're gifting it during your lifetime. So that's why ideally the things that you want to put into this kind of irrevocable trust, maybe you gift some kinds of cash, you gift some kinds of assets that you think will appreciate in the future. Ideally, you don't gift anything that is already appreciated a lot. So for example, that Nvidia stock, if it's appreciated 100, 200%, they're going to lose that step up in cost basis. So instead, children should ideally inherit those kinds of assets. And if you want to gift things out of the estate, you should gift cash, you should gift assets that will only grow in the future rather than have already grown at this point.
Got it. Thank you. And what are the common mistakes you see in estate planning?
Yeah, so there are three main common mistakes that I see. I think number one, which we alluded to, giving assets to any of the beneficiaries in individual name. So like I said, we had a client, they wanted to put children's name in there. What do we know? 20, 30 years from now, God forbid, child goes through some kind of divorce, some kind of creditor issue, the assets will get depleted. So instead, what we think is put the provision that just says, when you pass away, children have to create their own trust, and all of the money you transfer to that trust only. So that I think is number one mistake that people make, is giving it to their individual name. Do the trust provision instead. Number two is something called funding. So funding of the trust is actually what most people forget about. Funding means you have to actually update the titles and the beneficiaries so everything is inside of the trust. If you don't complete funding, it's like not creating a link between the private document and your asset. At that point, you don't avoid any of the probate. You just have a fancy piece of paper is collecting dust. So, so you have to make sure that you are completing the funding of the trust. Move all of the assets inside the trust. So for example, if you have home, deed needs to be redone. If you have accounts, put the beneficiaries on there as the trust. All of it gets moved in. Then only you can say that this is really completed. Now, third, and I think this one is very relevant for a lot of the FAPI community. Like Syed said, this is a retiree state. A lot of people weren't practicing in Florida. They've come from other places. We have a lot of clients from Ohio, for example. They're moving to Florida now. A lot of clients in New York that are moving to Florida now to retire. And they created their trust when they were here. Now, the problem becomes, obviously, this was based on New York law and New York statutes. So if you are moving, you do need to make sure that all of those other pieces inside the trust are also getting updated. And it's very simple. It's typically just the last 1 to 2 pages of your trust. You just update it for the statutes of the state that you're now staying in. Ideally, aside from that, we also see a lot of clients, they think, I just created the trust a few years ago. What else do I need to do? I just created once and that's it. It's done. But that's unfortunately not the case. Ideally, you should be reviewing this and updating this every 6 to 7 years just to make sure that there's all the provisions that you need in there. Laws are changing. You need to make sure that the trust is also updated. So these are the 3 mistakes: putting it in an individual name, not doing the funding, and not updating it on major life's movements, such as moving states or not updating it every few years.
Noted. And Keviin, I see a question here. If we have a trust listed as beneficiary, is that enough for funding on bank accounts, CDs, life insurance policies?
Yes. So if the trust is listed as a beneficiary, that is considered the funding. So that means that when you pass away, these will all flow into the trust. So this is considered the funding of the trust. One thing that you'll want to look into, though, is where are the assets going after you pass away? Is it going to children in individual name, or is it coming via their own trust as well? So that's a provision you need to look at. Is it in the trust already or not?
Thank you. So what is estate tax and what is the sunset for estate tax?
Yeah, absolutely. So estate tax essentially means that when you pass away, you have about a $27 million gift tax exemption. So net worth up to $27 million, you don't pay any taxes on it. If it goes above 27 million, then you might be looking at taxes of about 40%. Now, obviously, a lot of people had heard about this, especially in FAPI community, but in 2025, this is actually scheduled to go down. Instead of about 27 million is between husband wife, so 14 million per person, it was actually scheduled to go down to about $7 million per person. So almost cutting it in half. Now, between you and me, to be honest, Dr. Reddy, with Trump coming back into office and the other 2 houses also being Republican, seems most likely that this $27 million will actually get extended and may actually even increase. So even though this is there, a lot of financial advisors, they're trying to scare the clients and say, you need to do something right now. You need to start gifting right away. Even if it's not relevant, most likely this will be extended. So you don't have to worry too much as long as net worth is under about 20 million. If it's in that range of about 20 to 30 million, then this is where you want to start thinking about that gifting, like I was saying.
Got it. And so what is SLAT, the Spousal Lifetime Access Trust?
Yes, so SLAT is one of the ways that you can do this gifting, like I was saying. So SLAT is Spousal Lifetime Access Trust. What this allows you to do is gift to your spouse. So it's an irrevocable trust. Any of the money that you gift into this is out of your estate. But the benefit is, your spouse still has access to those assets. So Dr. Reddy, for example, if you gifted something out and for example, maybe you gifted $2 million away. If you need any of that $2 million back, then from SLAT, your husband would actually be able to go into that 2 million and give it to you. So now, obviously, there's a few things that come up with this. Number one is I hope everyone remembers any kinds of birthdays, anniversary dates, because if not, and your spouse is upset, you may not have access to it. So make sure that you're remembering these key moments. And second thing is, like we said, this is irrevocable. So for people that are in that net worth stage of 20 to 30 million and need to be gifting out, this is a great opportunity where you still maintain some indirect access to the asset, but at the same time, you're able to get it out of the estate. So it's a double win.
Good point. So what is charitable lead trust?
Yeah, so a lot of our clients, especially in the FAPI area, being retirees, they're very charitable minded, give a lot to charity every year. But, unfortunately, we see that there are some room for improvement. And I think one thing a lot of them should be interested in is something called charitable lead trust. So in charitable lead trust, what basically happens is, let's say you have $1 million that you want to give to charity. You put it into the charitable lead trust. Every year you have to give about 5% to charity. So 5% keeps going. At the same time, this money gets invested. So, for example, Syed was showing the stat, if you were just invested into things like SPY for the last 20 years, every year you're generating about 8% a year. So you give 5%, but the money is making 8% a year. So this delta, this difference of about 3% every year, this gets compounded and it grows, comes back to your family estate tax free at the end of that schedule. So it's very powerful if you're charity minded, you're giving about 5% to charity every year. Money is growing at, whatever it is, 8 to 10% a year, depending on your aggressive strategy. And all of that money, that delta, that excess, that isn't the 5%, that all compounds, comes back to your family at the end, estate tax free. So very powerful, especially for a lot of people that are having these charitable strategies in mind.
Good. So how much does the will and trust cost?
Yeah, good question, Dr. Reddy. So anytime that you hear us say trust is $4,000 automatically. So revocable trust, about $4,000, SLAT, another 4,000 or so, any kinds of charitable lead trust, 4,000 or more. Now, if you just need the will, basic will, so that's your healthcare proxy, power of attorney, that you can get somewhere around $800 to $1,500 basic, but most of you guys will need the trust. So all in, revocable trust, will, power of attorney, healthcare proxy, any attorney should be able to take care of this for you for about $4,000 ballpark.
And what is fiduciary? Why should we use a financial advisor?
Yeah, it's a great question. So I think there's two answers to that, and I'll start with what is a fiduciary. So I think a lot of you guys are probably familiar. What is a fiduciary? As a physician, you are also a fiduciary. It means you act for your patients in their best interest. So you have that legal obligation. So similarly, Syed, myself, all 20 members of our team, we had to take a specific license. We had to take a specific exam. That gives us the fiduciary status for finance. In terms of how that applies to financial advisors, there's a few things that you ideally should be looking out for. And it's one is these acronyms. So these CFP, CPFAs, you see a lot of these get thrown around. Ideally, you want to look for something like that in a financial advisor. In terms of using one, though, why would you ever use a financial advisor? I mean, we've spoken about it on this webinar. If you just invest in things like SPY, VOO, a few of these ETFs and mutual funds, you can do it by yourself, set it and forget it. You don't need to pay an advisor to do it. You can do it by yourself ahead of long term. You'll be ahead of the game. You use a financial advisor if you need help in the other areas of the financial plan. You need guidance on, things like estate planning. What strategy should you use? Should I use the SLAT? How much should I gift out? What should I be gifting out? If you need advice on things like this, or even tax planning, I'm thinking of starting my own business. Should I be LLC? Should I be S Corp? What are some deductions that I can take advantage of? If you need help in these kinds of areas, that's where it makes sense to, use a financial advisor. If it's just investment management, you can do it by yourself. Get a few mutual funds, get a few ETFs, low expense ratio, diversify it by yourself, and you're good to go. You're ahead of the game. If you need guidance in these other areas, that's where you use a financial advisor.
And let's see if the audience has any other questions. Let's see. So none in the chat box, but whoever is attending, if you could please go ahead and put your questions in the chat box. We're almost towards the end of the presentation, and thank you, Keviin and Syed. I myself learned quite a bit.
Sure.
As physicians, I think one of the bad things is truly we don't get educated on any of the financial stuff, and this is something we have to learn over time by ourselves, and it kind of becomes overwhelming. And sometimes you don't even have the time to think on all these things. So the presentations like this help quite a bit, actually. So we have a few questions. Are we going to talk about defined benefit plan, SEPA, IRA?
Yeah,
Yeah.
absolutely.
So for the defined benefit plan, it is like a pension plan. It's a eraser plan. You can contribute in a defined benefit plan, ballpark at the age of 52, around close to $200,000, and this money is completely pre-tax. But again, it's a tax deferred though. Compared to SEP IRA, the max you can do is 25% of W-2 income, or around close to $62,000, whichever is less. If you have taken extension for 2024, you can still open up a defined benefit plan or a SEP IRA for last year. But this webinar is mainly about state planning and market tariff. We can probably have another webinar about tax planning. And also we'll have a recording as well, and we'll send it to you guys. But this webinar specifically, we're talking about investment and estate planning.
And that's a good point, Syed, that if the attendees have any particular topics that they want to learn about, that's certainly something we can do in future webinars. So feel free to send FAPI also an email as to which topics you would like to hear about. So we have another question. Can trust include international properties?
Yeah, unfortunately, it doesn't work. We have clients in India, properties. They said the international law doesn't apply. It's only the US properties can be included in the trust. So, like for example, if you're in England, you have to have a barrister there and draft their documents as well. So obviously, the wishes will be carried out in America, but this trust will not be able to like have a weight in the properties overseas. The international law does apply.
Okay. And the recording of the webinar is the next question. Yes, we'll be sending a recording of this webinar. Next question, should we encourage our parents to set up trust to help our inheritance?
Of course, not just inheritance, but also avoid probate, divorce protection for yourself, creditor protection for yourself. But it just like the net worth needs to be a little bit, if you just have a house, maybe will is okay. But we would like to see a couple of, assets and everything. But trust is always better, rather not having anything. If they have house, retirement account, brokerage account, is always good to have trust because it avoid probates.
Perfect. What is cray and clap? How does it help irrevocable trust?
Yeah, you can do cray and clap, but these are mainly in terms of like a irrevocable trust. So it is only like Kevin mentioned, that this is something you can do clat, or you can do crut, CRUT. I think that's what you were asking the question. So the whole idea is you give the money to your children and you need income off of it. I'm talking about CRUT and CRAT. I'm talking about. This is not a charitable lead trust. CRAT, CRUT. This is a little different, okay? So this is like, imagine like I'm old. I'm like 70 years old. I'm terminally ill, but I will live about 5 years. But I just want to put these assets out of my state, but I want some income off of it. Is there any way to do it? So this is where CRUT and CRAT come into play. The difference between these two is one is fixed income, the other one is variable income. That's the main difference between these two. There is a case to make it. And how does it mix into a revocable trust? Whatever money uh, is left over, I'm just talking about revocable trust, you still need it. Like those are not part of the CRUT. So yeah, both arguments can be made, depending on your situation. But we have clients who have used both strategies together.
Thank you. I hope that answers your question, Dr. Shah. Any other questions?
So thank you, Dr. Reddy. Really appreciate it. We will have the recording available for you. You can, share with your members.
Yeah, thank you so much. Thank you, Keviin and Syed, for joining us, and very informative webinar, as you can see in the chat box there. So thank you, and looking forward to getting the email about the webinar recording. We'll send it out to our members, and if any of the members have other topics that you want them to discuss, please feel free to send us an email. Thank you once again, and happy Easter.
Thank you.
Thank you.
Thanks.
Thanks for everything. Bye-bye.
Bye.